Welcome to the Deep Dive. Today, we're doing exactly that. Plunging into the second quarter 2025 earnings conference call for Tenet Healthcare.
Right.
Our mission for this deep dive is really to cut through all that dense financial jargon.
Yeah, it can be a lot.
And pull out the most important nuggets of knowledge, the key insights, giving you a really clear understanding of where this major healthcare provider actually stands. We're not just looking at the raw numbers, we're trying to uncover the story they tell.
Exactly. It's about moving beyond just the figures to really grasp the strategic drivers behind them and, what these insights imply for Tenet's path forward and maybe even for the wider healthcare sector.
Right.
We'll dig into their operational wins, their key strategies, and how they're, skillfully navigating that always complex policy landscape. It just keeps changing, doesn't it?
It really does. All right, let's unpack this then. Tenet Healthcare reported some honestly, genuinely impressive figures for Q2 2025. When you first looked at the call, what were the numbers that just jumped out at you? The standouts that set the tone?
Well, what's immediately fascinating, I think, is the sheer consistency of their outperformance. It wasn't just a one-off good quarter.
Okay.
Tenet reported net operating revenues of $5.3 billion. But the real headline, for me anyway, was their consolidated adjusted EBITDA. It hit an impressive $1.121 billion.
Wow.
Now, that's not just a big number. It represents significant growth, 19% growth over Q2 of 2024.
19%, yeah.
And it gets better. Their adjusted EBITDA margins saw a really notable improvement. It was up 280 basis points.
Okay.
That's, 2.8 percentage points, bringing it to 21.3%.
Right.
This tells you right away they're not just growing the top line, the revenue, but they're doing it with remarkable and increasing efficiency, turning more of that revenue into actual profit.
That margin expansion is definitely something. Drilling down a bit, what were the main engines driving that growth? Was it across the board or specific segments?
It was pretty balanced, actually. Both core segments delivered strong results. USPI, that's their ambulatory surgery center business, high volume outpatient surgical facilities.
Right, the ASCs?
Exactly. They generated $498 million in adjusted EBITDA. That's an 11% increase year over year. Pretty solid for outpatient. But the hospital segment also saw really robust growth. Adjusted EBITDA there was up a significant 25% to $623 million.
25%, wow.
Yeah. And digging a bit deeper, same-store hospital admissions were up 1.6%. But crucially, revenue per adjusted admission, that was up 5.2% over last year.
Okay, so what does that tell us?
Well, it points to a strong payer mix, basically, more patients with better insurance coverage,
Gotcha.
and an increase in patient acuity, which reflects that strategic shift they've been talking about towards more complex, higher-value medical cases. Sicker patients, essentially, needing more intensive care.
So we're seeing growth and efficiency, like you said, beyond these operational wins. How did these strong results then feed into their capital strategy and their outlook for the rest of the year? What message are they sending?
They made some remarkably aggressive and, frankly, confident moves on the capital deployment front. It really speaks volumes about management's belief in the business.
Like what?
Well, they repurchased 7.2 million shares for $1.1 billion just in the first half of 2025.
Okay, serious buybacks.
Very serious. And to double down on that, the board authorized another $1.5 billion increase to their share repurchase program.
Wow.
That's a powerful statement of conviction, right?
Yeah, absolutely.
Plus, they significantly raised their full year 2025 adjusted EBITDA guidance. The new range is $4.4 billion to $4.54 billion. Now, that's a hefty $395 million increase at the midpoint compared to their previous guidance. It represents about 10% growth over 2024.
A big jump mid-year.
Huge jump. And their free cash flow outlook also shot way up, now expected between $2.025 billion and $2.275 billion.
So this really raises a key question for you listening.
Yeah.
What underlying strengths are giving them this much confidence to issue such a strong upward revision? What's really driving it?
That's the million-dollar question, or rather the billion-dollar question here.
Right. So what is the operational secret sauce? Let's look closer at USPI's performance. What are they doing right there specifically?
USPI just continues to execute brilliantly on its strategy. It's very focused. Same facility revenues grew 7.7%.
Okay.
And what really stood out was the 12.6% growth in total joint replacements performed in their ASCs.
Joints in an outpatient setting, yeah.
Exactly. This isn't just random growth. It clearly shows their successful push towards higher acuity, more complex procedures outside the traditional hospital setting. They also added 8 new centers in the quarter, again, with a clear focus on those high acuity areas like spine, orthopedics, neurosurgery. And management also mentioned a pretty robust M&A pipeline. They expect to spend more than their initial $250 million target for M&A this year.
So buying more centers too.
Seems like it. And their adjusted EBITDA margin for USPI was super impressive at 39.2%. That shows disciplined execution. What's really telling, though, is that net revenue per case was up 8.3%, even though case volumes dipped slightly by 0.6%.
Ah, so fewer cases, but higher value per case.
Precisely. It reinforces that strategic shift. Quality over quantity, you could say, or rather complexity over volume.
Makes sense.
Yeah.
And on the hospital side, you mentioned they've downsized their portfolio. So
Right.
what specific investments are they making to drive growth there, and how are they doing it efficiently?
Yeah, they're making significant but very targeted investments, expanding their network and supporting growth in specific key markets. The focus stays squarely on those high acuity service line priorities. Think complex heart procedures, ortho, neurosurgery, coupled with maintaining an extremely efficient operating platform. They really believe this combination can generate strong, ongoing returns, even with fewer hospitals overall.
Streamlining things.
Exactly. They've also actively cut overhead costs to align with that leaner hospital portfolio, which feeds directly into their margin expansion efforts. It's all about being strategic and agile with their resources.
It certainly sounds like a well-oiled machine. A strong balance sheet keeps coming up in their commentary. Just how strong is it? And what does that financial flexibility actually let them do?
You're absolutely right. To focus on that, it's fundamental to their strategy. They generated an impressive $743 million in free cash flow in just the second quarter.
Wow, in one quarter.
Yeah. And as of June 30th, they had a huge pile of cash, $2.66 billion on hand. And importantly, no borrowings outstanding under their $1.5 billion line of credit.
So lots of dry powder.
Tons. And critically, they don't have any significant debt maturing until 2027. That gives them enormous financial flexibility.
Right.
Strategic options to invest, buy back more shares, maybe pursue more M&A if the right deals come along. Their leverage ratio is also healthy, 2.45 times EBITDA. It just underscores their commitment to keeping debt low and generating strong cash flow. It's definitely a position of strength.
Another key area highlighted was their approach to costs. And that whole revenue cycle management piece. In an industry that's notoriously complex with billing and getting paid, how are they actually making improvements there?
Well, on the cost side, their consolidated salary, wages, and benefits, SWB, as they call it, as a percentage of revenue, improved quite a bit, 140 basis points better than last year, down to 41%.
Okay. Getting labor costs under control.
Exactly. And contract labor temporary staff was notably low at just 1.9% of that total SWB.
That is low.
That sounds like a multi-pronged success story. They're using a very data-driven strategy for managing capacity and labor, disciplined operating expense controls, better recruiting, strong ties with nursing schools. And they've also seen better retention rates. They're investing in their nursing and hospital management leadership, which helps keep experienced staff around and reduces the need for expensive temporary help.
Makes sense. And then on the revenue side, dealing with insurance denials, collections, that can be a real nightmare in healthcare, right? With all the complex coding and payer pushback, what are they doing differently?
They really view their revenue cycle capability as industry-leading, built on standardization and a lot of technology. Now, they did acknowledge that denial activities, disputes, documentation requests, all that stuff has ramped up across the whole industry since COVID. They said it's reached levels they find unacceptable.
Right. We hear that a lot.
But Tenet seems to have adapted strategically. They've deployed more tech, more automation, used trained offshore staff effectively, and even leveraged AI-enabled responses based on pattern recognition to handle these disputes efficiently.
Using AI for denials. Interesting.
Yeah. And they also stressed their consistent focus on getting documentation and coding right the first time. That helps reduce disputes down the line and speeds up collections. They even booked a $79 million favorable pre-tax impact from some extra Medicaid supplemental revenues related to prior periods in Q2, including a new program in Tennessee.
Ah, some catch-up payments.
Exactly. They expect the full year run rate for those kinds of payments to be around $1.1 to $1.2 billion after normalizing for these one-offs. It sounds like a constant battle, against this rising tide of paperwork and denials. But their Conifer business, which handles all this revenue cycle stuff, seems to be a significant edge for them.
That sophisticated back office definitely sounds like a competitive advantage.
Yeah.
Okay, let's shift gears a bit. How are external factors, things like Policy changes, broader market trends, how are those influencing their strategy and outlook? This is often where the real strategic chess game happens, right?
Absolutely. And this raises that important question about adaptability in a constantly shifting regulatory world. For instance, the CMS proposed rule about outpatient hospital care and potentially eliminating the inpatient-only list. That's seen as very positive for their USPI business.
How so?
Well, management believes it allows for even more innovation in their ASCs, those ambulatory surgery centers. It plays right into their strengths as an advanced ASC operator that's already handling complex, high-acuity procedures.
Yeah.
It presents a clear future opportunity, they think, to work with doctors to move even more complex procedures into that freestanding outpatient setting, assuming appropriate patient selection, of course. That's a significant potential tailwind for their strategy.
Makes sense. And what about the public exchanges? You know, the ACA marketplace volumes and those enhanced subsidies everyone's talking about expiring. How big a factor is that for Tenet, and what's their position?
Healthcare exchanges are still a significant and actually growing part of their business.
Really?
Growing, yeah. In Q2, they saw a substantial 23% jump in admissions and a 28% increase in revenues just from exchange volumes year over year.
Wow.
Exchange volumes now make up about 8% of their total admissions and 7% of their total consolidated revenues. So it's meaningful. Management is actively lobbying for those subsidies to be extended. They highlighted their critical role as a safety net, especially for people coming off Medicaid after the redeterminations and also supporting small businesses. It's also worth noting, management pointed out that letting these subsidies expire could disproportionately hit states with higher reliance on them, often including, what are sometimes called red states.
Right.
So there's a political dimension, but Tenet's position is framed purely around advocating for patient access.
Understood. Any direct impact from broader legislative changes, like the OBB bill we hear about, seems to cast a long shadow.
Yeah, the impacts from that OBB bill, often tied to broader health legislation, seem pushed out pretty far, mainly late 2027 or 2028. And management was very clear. Significant uncertainty remains around how it will actually be implemented.
So hard to plan for.
Yeah.
Very hard. They said new legislative proposals are even trying to roll back parts of it. Given all that fluidity and the long lead time, they explicitly stated they don't have projections for 2026 related to this bill. It just underscores how unpredictable that policy area is right now.
Gotcha. Okay, with all these pressures on payers, insurance companies, has there been any noticeable shift in their contract negotiations or an uptick in denial activity beyond what you already mentioned?
Their philosophy with health plans seems consistent.
Right.
Work collaboratively, create value, aim for predictability over multi-year contracts.
Okay.
They indicated they aren't seeing anything particularly unusual in current negotiations, and their guidance reflects that no major change is expected there.
Right.
And while, as we discussed, denial activity and documentation requests have definitely ramped up across the industry post-COVID.
They seem confident they've adapted effectively using their tech and automation. They specifically called out their Conifer business again, saying it's performing well in terms of yield, how much they actually collect relative to the dollars being disputed. That translates into strong overall results. They also keep emphasizing that accurate documentation and coding on their end is just critical to minimizing these disputes. It's really a two-way street.
Okay, makes sense. Finally, let's try and bring it all together.
Tenet is clearly doubling down on this high acuity strategy. But how does that fit with overall market demand? Are these two things working together, or is the strategy maybe compensating for softer overall demand?
No, they seem to be working very much in tandem. Their high acuity strategy focusing on those key complex service lines like cardiovascular, ortho, spine, neurosurgery, general surgery, robotics that continues to deliver results.
They also point into emergency-driven trauma care and their patient transfer strategy as key contributors. Those often involve sicker patients with higher needs, fitting that acuity focus. And while hospital inpatient surgeries were actually down slightly, their case mix index, which measures the complexity and resource intensity of their patients, that was up 1% year over year in Q2.
So complexity is increasing even if total surgeries dipped.
Exactly. It clearly indicates that shift towards higher complexity is happening. Management strongly reiterated that underlying demand in the macro environment remains strong. They emphasize their high acuity strategy is designed to support margin expansion and growth. It's not about only treating high acuity patients.
Right.
They really see the overall demand environment and robust when you look at it over multiple years, even if you get some seasonal ups and downs quarter to quarter. It's about capturing the most valuable segments within that strong underlying demand.
Okay, that clarifies things. Now, for our regular segment where we definitely don't offer financial advice,
Definitely not.
but instead engage in a little thought experiment. If you were a hedge fund analyst pitching an idea to your investment committee, what's an outrageous but plausible trade idea you might build solely based on what we've heard from this Tenet Healthcare earnings call?
Okay, connecting the dots here. An outrageous but plausible trade idea might be to go long Tenet Healthcare with high conviction, despite those known macro healthcare policy headwinds we just talked about.
Okay, long with high conviction, what makes it outrageous?
The outrageous part is maintaining that level of conviction when you're staring down significant known uncertainties, like the potential loss of those public exchange subsidies in 2026. That impacts, what, 7-8% of their revenue? That's not insignificant.
Right, that's a real risk. So what makes it plausible?
The plausible foundation is built squarely on Tenet's demonstrated operational excellence and that really disciplined capital allocation we've been discussing throughout this deep dive. The core rationale is their consistent, frankly outsized outperformance. That 19% EBITDA growth, the margin expansion across both USPI and hospitals, that's hard evidence. Their strategic pivot to high acuity services, especially seeing things like 12.6% growth in joint replacements in ASCs, that's clearly paying off. It drives higher revenue per admission and gives them a defensible growth moat in a tough market.
Okay.
Then there's the capital return. They are actively deploying huge amounts of free cash flow into share buybacks. That $1.1 billion already spent, the extra $1.5 billion authorized, that signals incredibly strong internal confidence from management and the board.
Actions speak louder than words.
Exactly. And critically, don't forget Conifer. Their sophisticated, tech-driven revenue cycle management gives them a distinct, probably enduring advantage in navigating that increasingly aggressive payer environment.
Right, the back office advantage.
So the idea basically posits that Tenet's internal strengths, their execution, their adaptability, especially in capital deployment and operational efficiency, will allow them to outmaneuver these external policy pressures.
Yeah.
That they can continue driving shareholder value despite the macro noise. It makes it a compelling bet on pure execution.
So there you have it, our deep dive into Tenet Healthcare's Q2 2025 earnings. We've definitely seen a company showing strong operational performance, a really clear strategic focus on that high acuity care model, and very disciplined financial management, all while trying to adapt to a super dynamic healthcare landscape.
Yeah, and this really raises, I think, an important question for you to mull over. How much can that kind of strong operational discipline and really smart capital allocation truly insulate a healthcare provider like Tenet from the shifting sands of regulatory policy, especially when those sands seem to be shifting so dramatically right now?
A great question to ponder. We hope this deep dive has given you some valuable insights and maybe even sparked some new questions for your own research. Thanks for joining us.